Good evening, Bethel Park, and welcome to the Bethel Park Live Well Speaker Series. Tonight we have Robert Fragasso from Fragasso Financial Advisors to talk about can you afford to retire? Welcome, Bob, and thank you for doing our series.
Chuck, thank you for inviting me, and Dave, thanks for facilitating it. Dave always does a good job. I've had the privilege of being on the cable network a couple of times. And tonight, as Chuck said, we're going to talk, the title being Can You Afford to Retire? And that is subtitled Confidence in Your Financial Future. The material that we're going to cover, and that would be me, the material we're going to cover is tried and true material. If you were taking a graduate course in finance, the same material would be taught, although this is packaged differently. It's put in a context for popular consumption so that you can assimilate it much more comfortably. It's not going to be burdensome. It's not highly technical. You'll see graphs, you'll see charts, but my job is to make it fun as you learn. As I mentioned, this is tried and true material. I've been teaching, I'm a resident of Bethel. I've been teaching for well over 40 years. And I'll skip ahead there. We've taught for many corporations, universities, just every university, community college in the area, organizations, nonprofits. So this is time-tested material. While it's academically based, it's forged on the anvil of everyday experience. So this is practical stuff. So again, we're going to walk through. My talking time is time paced at 45 minutes. I have more material here than we will use in 45 minutes. It's meant as a teaching aid. It's not meant as a class or a course. So don't be unnerved if I spend more time on one slide and less time on another. It's meant to be that way. So we're going to click through. We'll finish in 45 minutes. This kind of material, this course, as you can see, in its current form was first taught in 1997. Predecessor courses going all the way back to the 1970s and 80s. I remember teaching at the Bethel Library before there was a community center and before there were community programs. So many of you may be friends and neighbors of mine. We teach many seminars. These are some of them, and they're all geared to you securing your financial future. This one's meant for those on that plannable ramp up to retirement. Successful money management is for the accumulation stage. Can you afford to retire? To the pre-retirement, financial security in retirement, which I will teach for the Westinghouse Association of Retirees, which we go every couple of years and numbers in the hundreds, and they are retired, and then special workshops for women. So if your organization would like to have a seminar, get in touch with us and we can arrange it. So you will think about what are you expecting from this seminar? Yes, you're going to get some information, but that isn't what you're expecting. What are you going to do with the information? What are you hoping will be the unique personal outcome for you? So I would suggest you sort of get that in your mind so that you're framing this, pointing it toward what it is you're trying to accomplish. So you can expect assistance with the realization of your life's goals. And every life's goal is different. And many people have several life's goals, and those have to be juxtaposed and reconciled with each other. There's a planning process to get there. We'll cover that in summary fashion. The opposite of a plan is no plan. Good luck, have a nice life. So planning is integral to reaching your life's goals. You can't do it without planning, except by pure dumb luck, and that's not one of the chapters in the graduate school textbooks. Being prepared for retirement is determined by your knowledge and how you put that knowledge to work, not luck. Here's what we're going to cover tonight in a survey course format: inflation, taxes, rate of return. Now, as I say this, you say, well, I know about inflation. I know about rates of return. No, hold that opinion. Don't form it yet, because I think you're going to walk away knowing a lot more than you think you know right now, or that you do know right now. Risk, time versus timing, diversification, balance, asset allocation, the big three. And that's where we'll end up. And this will be 45 minutes, fairly fast paced. The human ear and mind can hear as fast as anybody can talk, and I will articulate so you'll get it. Remember, pose your questions at the end. Defining financial success. Your goals are your financial success. My goals are mine. Chuck's goals are his. They're not the same. Well, you have to understand and write down your goals. If you don't write them down, you greatly diminish your chances of achieving those goals. In my adult life, I always wrote goals. Back in the daytimer days, before I used an Outlook calendar, I had my goals written in the back of my daytimer. And it was one for business, one for personal, and one for the whatever it might be, spiritual, personal development, that sort of thing. And what happened was, and it wasn't luck, I realized my goals all along the way, and I modified them as I went, because study after study proves that if you write down your goals, you greatly increase your chances of realizing those goals. You're 33, according to this Dominican University study in California, 33% more successful in accomplishing goals simply by writing them down and referring to them. So, no two goals or plans are alike. You follow the same courses of action, but we all have our own unique goals based on our time frames, our family responsibilities, our unique tax brackets. We're going to understand our individual brackets tonight, varying risk tolerance levels, and you will understand your risk tolerance level that may be different at the end of this course than it was as you entered it, and your personal definition of comfortable retirement. One family wants to jet off to the French Riviera during retirement for vacations, and another wants to fish at Punxsutawney. That's a different cost structure. So we've got to articulate what retirement security, what retirement fulfillment means to us. It's critical to make your goals tangible. That's why writing them is so crucial. So what are your life's goals? Success starts with writing them down. If this were a longer course, we would spend more time going through examples, but I hope that I've piqued your resolve to create and articulate and write down your goals, because otherwise it's just a wish list. You've got to prioritize those goals. So let's talk about the 6 steps, how you're going to use those goals in successful financial planning. First is obviously determine your goals, write them down. The second is to take a picture of your current financial situation. So the direction from your current situation to your goal becomes your financial plan. So step 3 is to design a plan to get you from where you are now to where you want to be, taking into consideration all of the factors that I described a little bit earlier. Then you will implement the plan. So the first 3 we're going to cover tonight: implementing, monitoring and adjusting, continuing to educate yourself. That's a lifelong journey. But the first 3 steps are crucial for getting yourself and your family on the right road to realizing your life's goals. Determine your goals, write them down, describe retirement security in terms of today's dollars. Your plan will factor in inflation, which we are going to discuss. You cannot ignore inflation. Again, I suggest that you might feel that you understand inflation. Hold that opinion. We're coming to that. What will happen is you will project out in your financial plan what your roadmap looks like. Don't try to read this, but if you're 45 now and you want to retire at 65 and you want to end up your life in positive territory, having realized a comfortable retirement, and then maybe accomplishing some estate goals, taking care of children, grandchildren, charitable intent, whatever. Again, it's different for each of us. This is going to illustrate whether you're on track or not on track. If you do the analysis the right way, you may find out these numbers go red over here, which means you've got to change some of the variables. This is an equation: what you put in, what you earn on what you put in, what you take out, the time period over which you take it out, the rate at which you take it out, will determine success or failure. So it's your equation that has to be illustrated. And when do you want to know this? Now when you're 45? Later when you're 65 and you can't do much about it? 75 when you're in trouble, nobody rings a bell and says you're going to get in trouble. So this is the time right now, today being the first day of the rest of your life. So this is where you start. A financial plan considers taxes, cash flow, the productivity of your assets. That's crucial. We're going to talk about rates of return. Remember, I told you that. Projected estate costs, survivorship needs, education funding, solutions, retirement security projection. Most people, it's become a cliche, you've probably heard it, spend more time planning their next vacation. You remember vacations, right? Before, we're going to take them again. Most people spend more time planning their vacation than they do their retirement security. Spend at least as much time getting your plan in place so that you know that you're on the right track. So you design a plan tailored towards your lifestyle, understanding the purposes of a financial plan. By the way, we are all working from home, right? You see Chuck is, Dave's in the studio. You see Chuck's calendar behind him with the golden retriever. You may hear one of my dogs. I hear an old girl who's 16 years old and talking about herself over in the other room. So let's ignore that and let's understand we're all working from home. So can I afford to retire at the age I want? Can I afford to educate my children in the process if that's part of my goal? Can I provide for my loved ones and the next generation? So now you have your plan, you implement it, you regularly check it, use a professional or not. We'll talk about that at the end. That's up to you. Most people don't have the educational background, the tools, the resources, the time. You can do this yourself. You can make yourself knowledgeable about this, do your own financial planning, or you can use a professional, but they aren't all created equally. So you have to understand from whom you're seeking advice. Monitor and adjust the plan and then continue to educate yourself. Here are the 6 steps, those 6 steps that I talked about. You have to follow them. You can't make it up every day because life is what happens while you're making plans or not having plans. So your plan will get you through the inevitable vagaries of life, the ups, the downs, the storms, the peaceful tranquility. Solid plan will get you through all of life's events. Now we're going to switch to the 8 principles of financial management, the 6 steps in your financial plan creation and implementation. Now, what are the 8 principles of financial management that you need to understand at the executive level, not at the technician's level, at the executive level, so that you know how you're applying these principles within your financial plan. Even if you use a professional, you have to understand what that professional is telling you. A medical analogy. I trust my doctors. I trust my medical professionals, but I'm still my own case manager. I have to be able to understand what they're telling me and not blindly accept it. So it has to make sense to me. And that's part of me accomplishing what they tell me. And my mental attitude is part of my well-being. Same thing's true with finances. So 8 principles of financial management. Around the dial. We'll start with inflation. We'll understand the impact that taxes have on your decision making. It's not about how to do your taxes. It's about how to understand your taxes so that you're making solid decisions. Rates of return, risk, time, diversification, balance, asset allocation. Here we go. You ready? Inflation. 1926 is around the beginning of modern economic record keeping. We know what happened in the tulip bubble in the 17th century, but it really was not coordinated economic record keeping at that time. It was anecdotal historical information. But beginning with the 20th century, the Federal Reserve was created just a few years before this date. Financial institutions started to teach finance not too long before this date. So we were compiling information. So here we go with inflation. In the 1920s, we had inflation. In the 30s, we had deflation. You see, it went down. Prices went down. Look in the middle 30s, 1936 there. We had normal inflation. in the middle of the 30s. And then we go to all the way through. Now, when I say inflation, I'm going to suggest that your mind jumps to big inflation, when inflation was 10%, 12%, whatever. Look here, that's happened not even a handful of times in this entire almost century of record keeping. Approaching double-digit inflation happened only a handful of times. Most inflation centered on the under 5% trough there. And you can see that the average for the entire period was 3%. Even if we knock out the deflation of the early 30s, which was the Depression, it's still 3%. That's what the mathematicians call regression to the mean. So what makes us think that we're not going to average 3% inflation over any extended period of time? Right now it's under 2%, but it's going to average 3% if history is any guide. And by the way, we don't have any better guide than the recurring cyclical nature of history. So we will plot 3% inflation through all. So don't worry about big inflation. You say, well, 3%'s nothing to worry about then, is it? No, that's not true. Before I show you that, consider when you retire at 65, you have about a 20-year lifespan. Male, female, whatever, it's all in there. Now, when you hear that people live to be 80, that's from birth. And that includes an awful lot of things: wars, auto accidents, teenage auto accidents, that sort of thing. But when you're 65, male, female, you're going to live essentially about 20 years. All right, let's look at inflation. If you have 3% inflation for the 20 years of your retirement lifetime, you need $1.81 at the end of that period to live the very same way you were living on $1. Even 10 years later, you need a third more money. So inflation will come and bite you, and you won't even know it. But the inevitable nature of cyclical recurring inflation will eat away your purchasing power. And you will find yourself, if you're not hedging it with the right rates of return, then you will find yourself regressing in your lifestyle, cutting corners, eliminating, avoiding things that you would like to do but feel you can't afford to do. So inflation is a big consideration, and it has to be part of your financial planning. You say, well, I'll be retired. I won't have to worry about inflation. Yes, you will. Because within your retirement, you still have many considerations. You say, well, my house will be paid for. That isn't your only expense in your home. If you sell the big house and buy the smaller house, who do you know that actually freed up money when they did that? They moved into a different situation. There were more housing expenses involved in where they went. Family care, all those things, leisure, and definitely medical personal care. You will have more than half of your entire lifetime medical expense occur in the last 5 years of your life, even if you have insurance. So you will spend at least the same amount in retirement as you did before. You'll just spend it on different things, and those things are more immediately inflation sensitive. So you cannot in any way ignore inflation. And God forbid we have something closer to the 4%, which is what post-World War II was. Now you need twice as much money in 20 years, not just 80% more. So even 1% more average inflation could be a big deal. So we can't ignore it. We ignore it at our peril. All right, let's jump to taxes. We pay taxes in layers. So if you look at, let's use married filing jointly. This is the middle column. Our lowest tax bracket would be 10%, and then amounts over whatever that amount is for each of those, you're going to go pay 10%, 12%, 22%. Most middle-class folks will pay somewhere in the 22, 24%. This is middle class, 22, 24% top tax bracket. So what's happened here is that we pay taxes in layers. If you make more money, it doesn't pull all this money up into your top bracket. You continue to pay each layer, but the top layer in which you pay taxes, let's say 24%, is where all the action happens. So if you add $1, You throw it on top of the pile. You don't squeeze it in the middle. You don't put it at the bottom. So that extra dollar of earnings is taxed in your highest bracket. Conversely, if you save a dollar from taxation, you're saving it in your highest bracket. So it's your top bracket where everything happens. So you have to understand that bracket. You might look and say, so we're going into tax time now. Well, I made X and I paid 15% of X. Well, that's true on average for all the brackets, but that doesn't help you with your financial planning. You need to understand your top tax bracket. So let's look at rates of return. We look at, and this also touches on risk to a degree. We look at money market or short-term CDs right now, over the more recent period, paying about 0.5%. You say, well, I'm not getting 0.5%, but we're talking about average. Longer term bonds and CDs paying about 5% to 5.5%. Stocks over time, 11. Well, we look at that and we say, well, stocks are risky and short-term CDs are safe. Really? What do you mean by risky? What do you mean by safe? Let's take a look. If we think 11% is risky and 0.5% is safe, is it truly safe or is it merely guaranteed? Let's not make that mistake because the two concepts are very different. Here's what I mean. Let's take that middle return of 5. Here's that rate of return of 5%. Let's take that top middle class tax bracket of 24%. That's 1.2% of the 5 goes to taxes. You say, well, I'll pay that with other money. Well, it doesn't matter which pocket you take it from. That's still diminishing the total suit of your finances. So you earn 5, you're going to pay 1.2% in your top tax bracket. If you suffer 3% inflation, your net is 0.8 of a percentage point. You're not going to meet your goals, netting 0.8 of a percentage point. Now, I'm not suggesting that you put all your money in stocks. And I'm definitely suggesting you don't put all your money in short term unless you have very little money and you need it in the near future. The real answer is a combination of all of these: short-term emergency reserve money, fixed income, interest generating, and then longer-term stocks and maybe investment real estate if that suits you. So you've got to overcome this risk from the twin ills of inflation and taxation to earn a real rate of return that's sufficient to meet your goals. And that's what that schedule will show that I showed you earlier in the content. So let's look at that idea of risk. What is risk? Well, when I say risk, you think, well, I might lose all my money. Well, that's a risk of loss. That's sure, it's a risk, but you can mitigate your risk of losing all your money by diversifying your investments. I'll illustrate that momentarily. Well, how about fluctuating investment returns? If I go back, and I don't have the chart because this is a shorter course, but I show you what these were every year over 10 years or 20 years. It fluctuates. So the rate of return you would earn from fixed income can fluctuate, and you can get a better payday or a skimpy payday as a result. So you have to be concerned with fluctuating investment returns if all your money is in fixed income. And then certainly the last, that can be true when you're in stocks too, because you can make money or lose money. Volatility in your total portfolio. You can do all the right things. You can really diversify, mitigate loss. You can have different investments so that you're hedging fluctuating income, but the whole portfolio can go up and down. Well, that's not necessarily bad, but it's bad if you add in one more factor, the sense that you become emotionally invested in that volatility in your portfolio, and it makes you panic out. Then you turn a discomfort into a real dollar loss. So that is a risk. So it's the risk of loss, fluctuating returns, and then the volatility in your portfolio. You can mitigate all three of those by putting together a textbook-based portfolio that includes all of the investments that are appropriate to your situation. I'll illustrate. Here's diversification. If you bought any one of these companies, it could go bankrupt. Good companies. General Motors, Ford, If you go back during the Great Recession, there was real risk in those companies. Decades ago, who thought Chrysler would have gone bankrupt? And it did. The government had to bail it out, which was an odd thing. So during the oil embargo in the 70s. So any company can get in trouble. Think of Sears. Think of all the different companies that had problems where they were very solid companies before. So you mitigate the risk of loss by owning all of the companies that are appropriate in your situation, all of the bonds, all of the stocks. You'd have to make a case for nuclear winter for all of your investments to go bankrupt together. And then it wouldn't matter where you had it, in the bank or the insurance company or wherever, it wouldn't matter. So assuming normal economies with just ups and downs, you eliminate the risk of loss by sufficiently and properly diversifying your portfolio. Well, here are those fluctuating returns I talked about. So if you look all the way through from the recession of 08 through last year, the average return on a 6-month CD is 58/100ths of 1%. Take away inflation, even at the low rate of 1.66, and take away taxes, you are behind by 1.22% per year as a result of that. That's not safe. Let's go over here. Let's take a balanced portfolio. And so I can't make up a hypothetical portfolio, so I had our portfolio management people take all the balanced mutual funds in existence, the good, the bad, the not so good. They are, you can see, volatility in rates of return, but the average was 7.48. Same inflation rate, higher taxes. Now here, I overstated taxes because I taxed this whole return, which wouldn't be the case in a balanced portfolio. Some of it would be deferred, but to make the case on the very conservative side, you're going to pay 1.8% in taxes. Your real rate of return is just under 3%. Not minus, not 0.8%, but just about 3% after taxes and inflation. This is what we're striving for. You can live the life you want if your objectives are reasonable, and continue to maintain the capital that you've amassed through retirement if you're earning a sufficiently high rate of return after taxes and inflation. So we have to understand the effects of those two twin ills on our portfolio. We ignore them, as I said earlier, at our own peril. So the third face of risk is volatility. Go down. Doesn't look like it went down much. Yeah, it went down a lot. Look, percentage-wise. Up, down, up, down. These look like small jiggles, but you get upset about this when it's your portfolio. All right. Fluctuating values in the total of your investment portfolio are inevitable and must be understood. Volatility will lead us to succumb to our emotional fear, greed cycle. We tend to think that, I'll say this in a minute with a page, that bull markets always continue and bear markets go down and will always go down. Well, there's never been in recorded history a period where the market went down to nothing. So it'll go down, it'll come back up. That's what's always happened. But if we understand volatility and we have too much volatility in our portfolio, we can succumb to life's events. Think of divorce, where you have to liquidate assets, or human nature, which I will illustrate, the bear and the bull, greed, fear cycle, and then finally the results. You cannot avoid volatility, but understanding it and structuring the portfolio properly will enable you to manage through it to get the return that you can reasonably expect. Nothing's guaranteed in life. Crossing the street's not guaranteed successfully. So volatility of life events, what I call the 4 Ds. Death. So you think I'm a long-term investor. Well, your estate has to be liquidated. Maybe it's in the middle of a down market. So too much volatility could be bad. Disability, you might need to liquidate to accommodate for expenses during a disability. divorce, or employment downsizing. Hoping that they won't occur is not a financial strategy. So the appropriate, or what we strive for in building a financial plan, is the least volatility that allows us to reach our goals. And I will show you that on a graph later. Human nature. It's our nature to assume that when it's going up, it's always going to go up, and when it's going down, it's always going to go down. No, the meaning of life is a wavy line. The cycle of life, flowers, wars, markets, it all cycles. So it's, the truth is that sometimes tough times produce poor decisions because we succumb to our emotional reactions. I've used this example since then. In fact, I was teaching a course at Heinz to their management group that day. On October 19th, 1987, the Dow Jones Industrial Average fell almost 23% in one day. Think about your portfolio now. Down 23% tomorrow. How are you going to feel? Well, at that time, we didn't have the internet. It hadn't been invented by the guy who claimed he invented it. And so therefore, 1987 ended up 5%. But yet the people who experienced this drop in October couldn't get out fast enough. They were sending letters to their mutual fund companies, trying to call, the lines were jammed, and only so many people would get through the door each day. They were panicking out. But yet, a couple of months later, the year had been up 5%. The next year was up almost 17%. That emotional panic action based on one day's volatility caused them to turn a drop into a real loss. It came back. So we can plot reward on the vertical axis. And when I was in school, I hated graphs. And then somebody said, that's your money. And it became interesting. So this is your money I'm talking about. Return on the vertical, risk of volatility. It's called standard deviation on the horizontal. So this is the expected return. It's theoretical. You can't hit it. But the further, the more risk you take, the greater the return. So it's this diagonal line. So the closer you get to the line, the more efficient your portfolio is. So here, if you have all stocks, you're out there. You're getting the highest return of the three possibilities, but you're taking far greater risk. This is a balanced portfolio of bonds and stocks, the numbers that I illustrated to you, a much more reasonable volatility profile. And here are bonds. You're going to see in a moment in real numbers why this balanced portfolio takes the best of both worlds by decreasing volatility. So you must seek the return that you need, emphasis on you, to reach your goals. Striving for more return increases risk unnecessarily. If you don't need it, why would you take the risk? There are no bravery medals here. So the way you offset portfolio volatility, we're going to come back to it, is by putting all of the asset sectors, all the different kinds of stocks and bonds that are appropriate in your situation, in your portfolio. And that is your attempt to contain volatility to where it should be, not just accept what is. You engineer a return that's in keeping with your investment objective. You avoid over-concentration. This kept people safe during the dot-com bubble because the enforcement of the allocation in your portfolio would not allow you to succumb to the greed part of the cycle and load up on all those dot-com stocks. And then dampens volatility by avoiding correlation and utilizing covariance. Here we're verging on technicality, but it's technicals, but it's true. Correlation means everything goes up and down together. Covariance means some investments go up, some go down. The more you co-vary, the more you compress the volatility of the entire portfolio. All right, so from volatility, let's jump to our next topic, which is time, not timing. Predicting when to exit and when to enter the market is timing. It can't be done. Nobody has ever consistently timed markets. I've been in this business, next month will be 49 years. I go to conferences with all the smartest people in the country. I go to special classes at the top universities, graduate schools. Guess what? None of those professors, none of those experts, and I can't time markets. So time versus timing is where we're going to be. You will hurt yourself trying to time markets. Look at this. Daily returns during this 20-year period of time. Look at how volatile, day to day to day. You're not going to time that. Don't even try to tell me you're going to time that. I'm not going to try to think about timing that. But I can avoid this syndrome. If I stayed invested for that entire 5,217 trading days, my average return, even by experiencing this volatility, would be 7.2%. If I miss just the 10 best days out of 5,217, I would have cut my return in half to 3.5. If I missed the best 20 days, I cut it to almost nothing. The best 30 days out of 5,217 days, I turn negative and it gets worse. And I missed the best 50 days out of 5,200 days, I'm averaging negative 4.5% a year. You can't time markets. You're going to hurt yourself trying. Only by staying fully invested can you potentially reap the rewards. And you do it by dampening down the volatility and taking the average. And you got to have the staying power. You don't invest money that you can't leave in for at least 3 to 5 years. Better yet, longer. So predicting the market's not possible. Mistaken attempts will hurt you. Staying in the market. If timing the market doesn't work, what does? Time in the market. That's a big deal. All right, let's take our same period of time, 1926 through 2020. Here are the ups and downs. Year by year by year. Oh my goodness, this is pretty volatile. Up years, down years. Well, first thing we realize is there are a lot more up years than there are down. Second thing is most down years are about minus 10%. There were 1, 2, 3, 4, 5 periods in roughly 90 years where it went down more than 10%. 1, 2, 3 of them were more than 1 year. This is the Depression. Notice one of the best years in the century was right here in the 30s. Here's another one. Here's another one. See, if you'd have panicked out down here, you would have lost 80% of your money, right? Getting out. And you would have missed the recovery. I just finished a book, Jonathan Alter's book on the first 100 days of FDR. Seeing as how we're in the first 100 days of this administration, I thought it'd be good to read the comparison. And it was scary times. If you were 100% in stocks, you might have been tempted. Too much volatility from here to here. But you'll see in a minute, a balanced portfolio wouldn't have given you that volatility. So through all of this period of time, look at how volatile. Well, what if we looked at this in 5-year blocks? Same period of time. Let's just take 5 years, drop off a year, pick up a year, drop off a year, pick up a year. Rolling 5-year periods. Looks a little better, doesn't it? Only the early part of the Depression, later part, and then these others. Who's afraid of the big bad wolf over here, or the big bad bear? I didn't change anything. It's the same investment medium. 100% stocks, which I'm not recommending, but it's meant to illustrate volatility. All I did was have the staying power to stay with it for 5 years. Greatly increased my odds of a good return. How about 10 years? See the point? Time, not timing. You would never be able to time this. Don't tell me you would. I'm not going to believe you, and you can't prove you would. I've been teaching for over 40 years, and I've had a couple of people try to prove, and they couldn't prove it. All right. So the moral of this timeless story is stay in the boat. Don't get out of the water. Stay with the right boat. Have a sturdy boat, and you'll find yourself in calm harbor waters. All right, financial success requires diversification, balance, and I got to do this fast, but there's some really important stuff here. Diversified portfolio means you have many eggs in your basket, not just one. You balance your portfolio by having many stocks, many bonds, different kinds of stocks, different kinds of bonds. Just balance, not asset allocation yet. Let's take those big stocks that I illustrated, how volatile they are. And let's look at the best year, up 53%. By the way, they were in the 30s. Let's look at the worst year, down 43. Remember I said you'd have lost 80% of your money? All right. How about small stocks? Higher return, average return. Look at the highest return. Look at the lowest return. So the volatility index from best to worst was 96.5% with big stocks, 200%. That means a lot of loss. Well, let's look at bonds, those safe bonds, average 5%. Bonds fluctuate in value. Certificates fluctuate in value, right? You cash them early, you get a surrender penalty. That's the bank's way of telling you that the underlying bonds fluctuate in value. It's only guaranteed on the day it matures. That's true with bonds. All bonds fluctuate in value. The best year, up 32, worst year, down 11. So the volatility index high to low is 44%. Half the return of stocks, half the volatility. That's economic law at work. It always works that way. If I take any block of time out of here, it's going to look the same. It keeps regressing to the mean. That's why when people say new paradigm, I want to throw up. There are no new paradigms. It just gets addressed differently, but it comes circling back around. Well, how about if I take half big stocks, half bonds? My return is 8%. Closer to stocks than the bonds. Why? Because of the covariance of bonds and stocks. Compress the volatility. If you don't get down as much, you don't have to go up as much to beat the person who went down more. So your return looks more stock-like than bond-like, but your volatility is 53% more bond-like than stock-like. That's what you're striving for. The right return with a decreased volatility. Even if you throw in 20% small stocks, 40% big and 40% bonds, your return looks like stocks and your volatility is still about 2/3 of what stocks alone would be. So you can engineer the risk-reward trade-off that you need for your portfolio with the volatility that you can handle. But you can't just throw a dart and find it. You start with your goals, you start with your financial plan. Then your financial plan leads us to the right mix. What I showed you here was just mindless balance. Now it's mindful and scientifically based asset allocation. This on a before and after basis would be the allocation that an investor chose or defaulted into. Maybe their coworker told them how to allocate their 401k this way. And the average return is 6%. And the volatility is what I'm going to show you. Let's dampen it down from 75% in stocks, 25 in bonds, to 60% in stocks, 40% in bonds. The return paradoxically goes up. Why? Because of what I described before. Dampen down the volatility. You raise the trajectory of the return and your average is higher. It plots like this. On the volatility scale and the return scale, the green dot is before, the purplish dot is after. You paradoxically raise the return and lessen the volatility. And you did that with intelligent asset allocation. So your financial plan is your roadmap. You can create your own plan. You can try and do the online things. Have fun with that, but this is serious stuff. This is your money and your retirement. You need the judgment, the time, the experience, the resources, the education, and the temperament. That's why doctors don't treat themselves or their families. So where do you seek guidance? traditional brokers, discount brokers, insurance agents, banks, accountants, robo-advisor, independent advisors. Oh, that's a different color. Maybe that means that's different. I don't know. An independent advisor works for you, not for the house. Isn't distracted with other activities like doing tax returns. Isn't mindless on the internet. So I would, obviously I'm biased, but I got to create my own return or my own firm over 49 years. And of all these choices, this for me was the right choice. And our clients seem to think so too. So here are the pros and cons of each of those. I'm not going to go through them. If anyone wants this slide deck, just email me through our website, Fragasso Financial Advisors. It's frgassoadvisors.com. And when you're interviewing an advisor, here are some of the questions that you might like. You have to ask. Here are the steps. The plan gets you through step 3, then you implement, monitor, and continue to educate. So we have offices in Cool Springs. We have an office on Washington Road. We have 3 other offices downtown, North Hills, Beaver. So if you need to talk to somebody, all of our people are salaried. We don't have commissions. So if you want some complimentary initial conversation, call one of our offices. If you want this slide deck, email me and I'll be happy to send it to you. As you saw in the beginning, it is copyrighted. So it's for your use, not for reproduction, but I am happy to share it with you if you feel this would be helpful for you to have further conversation. So I went 2 minutes over and I apologize for that. And Chuck, do you have questions?
First of all, like you, Paul, I grew up in the inner city, and our parents were always, you have to have money to make money in the stock market. Is that necessarily true? And when you start in your 20s, how much should you invest of your net paycheck?
That's a great question. You did your homework, huh? What part of the inner city?
Mount Washington.
Okay, I was next door to you.
Where we at?
Knoxville, Mount Oliver. Our
Nice
company is
experience.
now invested in the Hilltop Association to try and help that whole area there where you grew up and I grew up.
I hope it comes back.
Yeah. Well, little by little, if we all pitch in, you know, it'll go where the best we can do with it. But the answer to your question is, in today's world, it's easier to do, especially with contributory retirement plans. You should not invest money, as I said earlier, that you are going to need in the next 2 or 3 years. Sometimes people come to us and say, I want to buy a house year after next. Can I invest my down payment money until then? No, don't do that. Put it in there, earn 0.4%, because you want the money to be there in 18 months when you're looking for a house. And before you make your down payment, you've got to be sure it's going to be there. If you can leave it there for 3 to 5 years. Now, with the advent of no load, you should never pay a sales charge to buy a mutual fund. No load, low cost funds, you can invest small amounts of money, but start out with a balanced fund. Now, again, this is generalized advice. It's not meant for someone to run out and do it tomorrow. I'm just trying to answer your question. If you're balancing your portfolio and it's asset allocated reasonably within that fund, or maybe with several balanced funds, then you can reasonably put a small amount of money in, provided you can leave it there. You should have emergency reserve money on the side. So if your water heater goes or you need a new transmission, you're not going to rip up your portfolio. So yes, you have to have money to make money, but my parents were immigrants, but they said to me, and I started with paper route money, start buying mutual funds. Well, back then I had to pay a sales charge. Today I could do it with no load funds. So even with paper route money, as long as I didn't need it, I got started with it. And I used it later on as a down payment on my first house. So, but that was a sufficient time from paper route to first house that the markets did what they were supposed to do, but I had good guidance, even though they were immigrants. So yeah, you can do it, but definitely in today's world, pay yourself first. Remember the top tax bracket? If you put $1 in your 401k plan, you're putting it in before tax. So you are saving your top tax bracket. That money's going to work for you. So now you're putting all the principles I taught. If you're putting into that contribution, if you're putting money in your retirement plan. And it's yours, you can take it out later on.
You talked about, investing. Now you build up a nice portfolio over, say, 30, 40 years. I really want
I'm
to,
sorry, I missed a little bit of that.
you've been investing, you build up a nice portfolio over 30 or 40 years. And now you go, okay, I want to help my kids out. Do you keep it in the portfolio for them, or is there like a CD or something that you can help them with paying their bills after you're gone, or can you set something up like that?
The answer to that question depends on your individualized circumstance and financial plan. So let me give you a very generalized answer. And when in the larger course, I have a big red caution, or excuse me, a big yellow caution light. Before you start gifting, make sure that you're not gifting money that you're going to need. So the first thing is you do your financial plan and make sure you're going to be okay. And then that analysis will show if you have excess, that you can give some extra money to your kids on a monthly or quarterly or annual basis. All right. Normally that doesn't happen till later in life, to where you've handled all the bricks and the sticks and the education expense, and now you're retired, and now you know you've done it the right way and you've got excess capital and you can start to gift. And there are tax-wise ways to do that. So for example, you can do an annual gift each year and it's excluded from estate and inheritance tax. You have an annual exclusion. So you would want to gift under that annual exclusion. Secondly, if you're helping grandchildren with college expense, you pay it directly to the institution. It doesn't count toward your exclusion. So it's what you can afford. And if you can do it on a tax-wise basis, you're having an even greater impact. What greater impact? Equal to your top tax bracket.
Okay. And when you start taking out of your portfolio for retirement, do you pay taxes on as you take it out?
If it's your 401k plan, the answer is yes, because you put it in before tax. You did not pay tax on the accumulation. So it's only fair that the government gets its share. But I can prove to you mathematically, you're going to have a lot more money from which to pay taxes as a result of not paying taxes on your income and on the growth on your contribution all those years. So yes, you'll pay taxes, and don't resent it, because you have a lot more money than you would have had otherwise. Now, if you give from your personal portfolio, it depends on the nature of the gift. So for example, if you took money out of your savings account and gave it to your child, there's no income tax consequence. There could be a gift tax consequence if it's over the exclusion amount each year. You with me so far? All right. If you gift a security to your child and your grown child sells it, or your grandchild sells it, then it's recognized in the child or grandchild's tax bracket, which may be lower or higher than yours. So the decision of whether you should sell it and pay the taxes and give the cash, or you gift the security and they sell it to use the cash, depends on the relationship between your tax bracket and theirs. That's why financial planning never stops. This has to be part of your ongoing. But once you have your plan in place, this stuff becomes a lot more easy to do, because you're facile with it. Your financial advisor knows what's going on, and you do this as part of your annual reviews and your quarterly reviews. You get those questions answered. Those are good questions.
What would you say the one piece of advice you'd give to a young person just getting out of college that has, that mountain of debt that we know that a lot of the kids are getting now? What would you give advice? Would you give them to start with, $5, $10 a paycheck, or, whatever they can?
Yeah, that's also a good question. First, make sure that the debt is structured so that that person is paying the lowest interest rate. So it may be refining in some way. I'm not recommending that. I'm just saying, make sure that there isn't a better way, a cheaper way to carry that loan. Next, contribute to your retirement plan. You can afford to. Inertia means a body at rest stays at rest, but it also means, the other part of the definition, a body in motion continues in motion. So if you start putting $1 away, later on you'll put $2 away, you'll put $10 away. So you keep the body in motion and pay down that debt. But you can do everything. Now, Can you go to Hawaii? Can you buy the fanciest car? Can you do it? No, no, you can't do all those things. So that's where little delayed gratification can come in to bear. I'm in touch with a friend from military service from 50 years ago. And he was just that way as a young man, you know, a 20-year-old. And today he's retired and he's extremely comfortable. And we're in regular touch. He has met all of his goals, but he always did what I said to you, and he didn't deprive himself. He just eliminated the unnecessary. Three kinds of households: those that spend all that they make and accumulate nothing, those that spend more than they make and accumulate debt, and those that spend less than they make and accumulate assets. All three will live well. It's a judgment choice. It's just like you can eat everything in the refrigerator or you can eat healthy foods. Look at how you're going to look, one choice versus the other. Same thing with your finances. There are things you don't need to buy.
I think you learn that as you get older.
Yep, exactly.
So
I'm here for as long as you want me to be here. So whatever questions you have.
no, I think that's it. We thank you. Maybe we'll talk down the road about maybe doing a seminar at the community center or something.
Good. Love to do it. And we've got a couple of our people are Bethel Park residents. Our Cool Springs branch manager is Bethel Park. Our Washington Road manager is Bethel Park, and they're both good lecturers. So people don't have to listen to me all the time. So we'll get some younger guys in there too, or gals. And our manager of all of our branches is a Bethel Park resident. So, and she's an excellent lecturer. So we'll get some people in there for you, and I'll be happy to come back anytime.
All right. Well, we thank you. And Bethel Park, thank you for joining us tonight. And tune in next month. We will have Dr. Ken Campbell. He will be talking about taking care of the caregiver.